I'm Charlotte McLeod with investingnews.com, and here today with me is Matthew Piepenburg, partner at Greyerz. Thank you so much for being here. Great to have you.
Well, it's great to be back, Charlotte. It's always a good time, always a good
Yes.
conversation.
Yeah, so good to be speaking with you. And we're here at the Rules Symposium. I think we've made it far enough into the conference that I can ask you to share a little bit about your takeaways, conversations you're having, themes you're noticing.
No, I mean, first of all, Rick has really outdone himself. Again, I got to say, I mean, I get to see him every year in Zurich and sit down and think through things with him. But in terms of just creating an event, I got to give him kudos for that. Just the smoothness of it, the selection of the individuals here, the selection of the vendors in the mining side and the equity side. He's really screened them, so it gives the visitors a look into Rick's thoughts. And obviously, Rick and I have very, very similar views on the longer-term direction of a metal. But Rick has veteran-like experience with beyond just the gold-silver discussion. He really understands hard assets on the longer, the longer spectrum, and certainly in the exploration or the royalties in the mining in silver and gold, he has tremendous experience. And so I think what I've seen so far, very happy visitors who are getting kind of their pick of the crop in terms of listening to the management themselves describing their opportunities. It's a very, very selective process when you're looking at the mining and the equity side, which, obviously at Greyerz we're more conservative, boring, wealth preservation, in some ways an easier task just to explain the macros and to explain the need for health insurance for dying paper currencies. But for those who have that DNA that I used to have, certainly in speculation, looking at the equities and the embedded leverage in the mining side, Rick has given you a nice, I think, menu of options to choose from. And so far the feedback's been positive, as everyone I've talked to. And then, of course, the larger on top of this whole umbrella is the discussion of the gold and silver price, only because on the equity side, the spot price versus the production cost is a big part of it. And so our view is not just on price prediction, but understanding the direction of precious metals is certainly important for our clients at Greyerz, but certainly also for the mining side. Where is this price? What explains this price? Where are we headed? To the extent there's some directional signals without being psychic or a mug's game and predictor. It's a fascinating time right now this year in 26, especially after we met in Vancouver with the euphoria of January.
Yes. I was thinking back to that January time. It was very euphoric. And so it is a different picture right now in terms of at least the gold price. And talking about understanding what's behind that, I wonder if you can speak about what's driving that decline. You had put out a great piece that covers how what we're seeing is actually typical for gold in times of crisis. So I thought it would be good to go into that.
Yeah, so much has happened since January. When we met, it was just days before Silver Friday, and silver going from 120 to 78 in a weekend, that was a clear manipulation. We could spend hours on it. It's shameless manipulation, but anyone in the precious metal space is fairly familiar with the tricks. January was fascinating because it was almost, when we sat down in Vancouver, I said, remember, this is exciting, but gold doesn't move in a straight line either to silver. I did not predict, per se, a war or conflict in Iran within 2 months, or Silver Friday at the end of the week. I knew there would always be the tricksters and the manipulators and the headline spin, because silver was squeezing the big banks when silver was hitting 110, 115, 120, and the major, large, GSIB banks, the New York banks, were short the position at leverage. It wasn't just a debate, it was a matter of survival to push that price down. And what we saw on Black Friday, without getting all the details, was fascinating. JP Morgan got out at the very bottom. You had the market shut down. You had electricity go out. You had margin hikes. It was such a shameless fix. But anyway, that certainly had an impact on the metals space, and a reminder that we're all still little serfs to the lords of the COMEX and the New York Exchange. And add on top of that, the conflict in Iran created some forced sell-offs. So long answer to a short question, what I saw that we couldn't predict, even though we know there's volatility when prices rip that high, what I saw since January in Vancouver was really 3 major forces. The first being, obviously, the forced sell-offs. When you see the COMEX make those moves and you see silver lose 38% overnight, a lot of the levered tourists in the precious metal space, including silver ETFs, were absolutely shaken out of the trade, understandably. They came in without a desire for wealth preservation or long-term thinking. They saw a momentum trade. They bought at the top. Typically in levered ETFs, those daily rebalance, so they had to sell. Same thing with gold. We saw the same thing with a lot of the quote, shadow banking system. The hedge funds in New York and elsewhere were playing the momentum trade with gold and silver. They are algo-driven as well. They are not at all interested in wealth preservation, longer macro themes. As anyone would do in that space, they have to protect their losses. When silver and gold hit a certain point, stop losses were hit, boom, massive sell-off. Sell-off puts price pressure down on the prices. And I think when you top onto that, what happened with the conflict, usually war, gold loves chaos, Clem Chambers, gold is for war, et cetera. Why didn't gold rally in the backdrop of so much conflict? And I think that was actually ironically a bullish indicator for gold, and I'll explain why, because when there is a crisis like this, an oil crisis, an energy crisis, without getting into the weeds of why this war was fought, all that, very complex, very fascinating, it's definitely, certainly for the petrodollar, the U.S. Treasury, gold hegemony or dollar hegemony, but what we saw very early on, because this was supposed to end every 2 weeks, and it never did, and countries that were rich in oil, like Saudi Arabia, import just about everything else. They needed liquidity to keep the lights on, so to speak, for Saudi Arabia. Saudi Arabia made a massive sale of gold, and that, of course, was a forced sale. It wasn't desired, but they took their most valuable and liquid asset, and they sold. What's even more compelling, and many have known this, is Turkey. Turkey has loved gold. They've been stacking gold. They did not want to sell their gold, but it imports 90% of its natural oil and gas, and it needs petrodollar dollars. So it had to liquefy its U.S. Treasury holdings and its gold holdings. What's interesting, and I saw this in Switzerland where Turkey did a swap without getting into the weeds, the swap just meant they're collateralizing their gold, they're going to buy it back later, but they literally needed to sell a large tonnage of gold just to import oil so they could literally keep the lights on. What's interesting since then, and since quote-unquote stability, whatever that means in Iran or the Middle East, they're trying to get that gold back. What's interesting is they don't want the U.S. Treasuries back, and that's a larger implication. So there was a lot of forced selling because of the conflict of the best and most valuable asset. In some ways, that's actually a sign of the direction of gold's prominence next to the U.S. Treasury, which is a much larger theme. There was certainly a sell-off in the ETF space and levered ETF, and certainly in the hedge fund space, but also finally rising yields, which we can talk about. Rising yields, well, 10-year, the U.S. 10-year, the UK gilt, the German Bund, the Japanese JGB, highest yields in decades. Pet rocks like gold and silver offer nothing, so it's a headwind for gold and silver. What's fascinating and so deliberately misunderstood and misreported is there really aren't positive yields on these bonds. Objectively, inflation is far higher than the yields, but inflation is simply and deliberately misreported. But it's not a fable, but fact. And so, nevertheless, traditional investors just see yields up, bad for gold. We can talk about all the reasons why that's actually good for gold for those who understand it without being an apologist. It's actually an incredible moment right now for the metals. It was in January too, but again, it really depends on the listener's profile. If you're here to speculate, understandably, or trade, or swing trade, or go long or short, or pair trade, that's a very different interest than mine or Von Greyerz, and it's a very different skill or risk. If you're interested in owning gold as life insurance for openly dying paper currency, whether you were buying at 5,500 or 5,300 in January, or whether you're buying at 4,100 today or 5,000 in 2 months, whatever that is, it really is begging the larger question of that's fine because we're looking at decades ahead and we're looking at a different argument. So for us at Von Greyerz, this has never been about price action. That's a distraction. The real issue for us is what's happening with currencies and therefore what's happening in the bond market, which is boring but essential.
Well, let's go in that direction because I think people at this event and hopefully in our audience are interested in that deeper understanding. So let's see what you're watching going on in the bond market and how that plays into the long-term gold story.
Yeah, and again, and I really want to respect how, at least on the surface, how boring the bond market must seem to people who want to hear about great beta trade in mining or equities or metals and hard assets. And I actually understand that, and I think it'll give them more confidence, actually, and a little bit more optimism if they do understand something very simple. As bond prices go down, yields go up. And bond prices go down when there's less demand, and there's less demand when there's less trust. And I think what we're seeing right now across the board in sovereign bonds is, decade highs in yields means more than just rising costs of debt. It means decades lows in trust. The U.S. 10-year Treasury is absolutely the essential collateral for the world. It is the key bond, the key IOU, the risk-free return. And for the entirety of my life, that was the sacred cow. What is so interesting about what the bond market is signaling now, rising yields without the Fed raising rates yet, we can talk about Warsh and that whole clown show. Rising yields, no action from the Fed is a symptom of distrust in Uncle Sam's IOU. This is extremely important because that is the collateral for world trade. It's the collateral for derivatives. It's the collateral for interbank lending. It's more than just yields are rising. No one likes the U.S. 10-year. There's so much more implications behind that because what is really happening is we're talking price action right now in gold and silver, and that's making the headlines, and so is SpaceX trading at 100 times earnings and IPO overvaluations, and all that naturally gets the attention. That's a classic trick, but what you're not supposed to see is that no one's buying U.S. 10-years, and therefore some other new collateral is rising as to replace this once sacred collateral. And objectively, without being a gold bug executive out of Zurich, you could be in the bond market, you could be a risk asset guy in New York or London or Chicago. We all know what that new asset is. It's gold. And this is what we've been talking about for many years. And it's accelerated at a pace post-2022, post-Ukraine, post-weaponization, faster than even I expected. And like many, I was the first to say 22 was a watershed moment. But the level of distrust and the empirical objective data behind it, is fascinating, and I think is very deliberately ignored. The pace of U.S. Treasury dumping is extraordinary, as is the pace of gold stacking. And when you look at the last 11 quarters, the last 10 of those 11 quarters was over 200 million tons per quarter. May of this year, China alone was 160 tons. Again, these are just numbers, but think past the numbers, the implications are extraordinary. If everyone on your street is selling Toyotas to buy Fords, there's a clear trend towards Ford. But this is far more serious because if gold becomes not a gold-backed BRICS currency or a gold-backed yuan or a gold-backed XYZ, gold is just becoming a more prominent collateral. And what we're seeing, and this may be conspiracy theory, crazy, it's exactly what I would do if I were a broke sovereign, a central banker from Brussels to DC to Japan, and I was a commercial banker, which are the shareholders of the central banks. I'd say, folks, we need a fire sale again in these metals. We need to create headlines. We need to create margin hikes. We need to make a sell-only exchange. We got to push the price down so we can buy more. And that's exactly what we've done since January. So there's a lot of reasons, because we don't know the undisclosed amount of exodus from the comics where that gold and silver is going. It's probably going to sovereign wealth funds, commercial banks, and central banks. My point is, when you see China playing the long game patiently, stacking this, when you see other central banks making record purchases, when you see a 5x increase in gold since 2022, when you see the massive exodus of gold and silver off the COMEX, and when you see literally the pace of change right now, and central banks now hold more gold than they do U.S. Treasuries. Again, for boring guys, these are headlines of momentous implications for the masses watching soccer and football, which I enjoy. This isn't going to make sense. For those who understand the metals, this is the direction of the hockey puck. And it makes the longer-term confidence in gold so obvious now. And I'll pause there. It's a lot of data, but it just makes it so obvious.
It does, and I think it gives people an indication of maybe what they should start to think about doing themselves.
Yeah. Mm-hmm. Well, it's just as it is, and I'm no fan of central banks, absolutely not, from the BIS to the Fed to anywhere else. I'm certainly no fan of the big commercial banks who are the shareholders of this, but do what they, look at what they're doing, not what they're saying. And whether you like them or not, they have immense power, more so than anything I say on a platform. But I will do what they do. I don't respect them. I don't like their mechanizations, their lack of transparency, and their insider games and their complete distortion of free price discovery. La-di-da-da. I could go on and on. How many ways do I hate the Fed? But like it or not, they are stacking. The central banks are stacking gold at a fire sale for a reason. Most citizens are chasing tops right now on IPOs and SpaceX for a reason. You are the plankton, they are the whales, you are the suckers, they are the insiders. I wrote Rigged to Fail. I've seen this trap, this movie so many times. So it's not just come to Switzerland and buy my gold. No, just please understand what's happening here. They're forcing the price down for themselves. You're missing out. The direction of this trade is so obvious. And what they're saying is it's not the end of the dollar, it's not the end of the U.S. Treasury, it's a repricing of that. Gold is more trusted as a collateral for international transactions. That's why we're seeing Enbridge and the BRICS. That's why we're seeing debasement trades. That's why we're seeing what's happening with de-dollarization. And that's all kinds of other evidence in Asia, which we can get into. But it's clear. It's not a case. And so you want to have this asset when it's still off the radar, because when it hits the radar, it doesn't matter when. I'm not timing it. And we can talk about some dates, but I'm not timing it. I don't need to time it. It's such an obvious fat pitch. And again, that is beyond the gold camp. That is all of us who track hard assets, look at currencies, look at rates, look at swaps, look at risk assets. We see this. And again, I just can't be more evangelical enough. I realize people think you're selling your book. Egon and I want to educate. Not everyone can be a client at Von Greyerz. Everyone should be buying some gold and silver, especially those who can't afford it most of the time. I think it's a clarion call for that right now.
Well, and you mentioned dates. We don't have to pinpoint a date, but what dates are you watching?
I look at massive turning points. There are certain years like 1944, Bretton Woods, 1971, welching on the gold standard of Bretton Woods. I look at 2020, when the World Trade Organization exported the American dream to China. I look at 2022 when we weaponized the neutral reserve asset like the U.S. Treasury in 10-year as a watershed moment. I look at 2025 with the Genius Act to make stablecoin the new sponge for U.S. Treasuries. Very desperate, very clever, very desperate. So these are all desperate turning points. What is a date that I'm looking at this year, which again, deliberately not making the headlines, it's a little too complex for the traditional investors, they say, so no one will think about it. I think your viewers are complex enough, I know they are, to understand the implications of this. But again, there's a deliberate control of not only interest rates, but of information in the world we live in. What's an interesting date is June and July of 2026, because this year in boring old crazy Asia, China, those silly people are very much ahead of us, whether you like them or not. And what the ICBC, one of the major banks of China, has just said is we're not going to allow the paper trade, futures contracts for our banking clients. They're going to make the margins 140%, effectively making paper claim levered gold trades impossible. And all the other big banks followed. That is important for a number of reasons. The official reason is they're trying to protect the Chinese citizens from price volatility. But just bear with me a second, because this is very important. I've written ad nauseum for years about the COMEX and the LBMA markets and how they legalize price manipulation and fraud legally. And China isn't stupid. They've been watching this since 1973, the fixed game on the COMEX in London and New York and in the CMA group. They know that we use massive amounts of leverage to force the boot to the neck of gold and silver so we don't have natural price discovery. Fast forward to 2026, China is saying for us to have more credibility, more trust, and more natural price discovery, we are now going to try and make the paper trade, which an open secret that it's a lie, we're going to call the bluff on that. We're going to go focus more on physical supply and demand. Imagine that. Physical supply and demand. Imagine that. The West has certainly not been able to handle that for decades. And as they're doing that with the big banks in China, they're doing a clearing and settlement arrangement with Hong Kong. Because of the capital controls in China, money flowing in there is like a roach motel. It doesn't come out, people are worried. So they use Hong Kong as the receiver gate, so to speak. So Hong Kong will take in international money. The gold will be stored in Shanghai and China. And they're going to basically create, and becomes effective by end of July 24th, now what's just happening with the banks, but this clearing settlement system is going to be based far more on physical gold than paper gold. Paper gold is the bête noire. It's the skunk in the woodpile of the whole lie since '73 in the COMEX and London markets. So I'm not saying on July 24th or August 1st, free price discovery comes to gold in China, in Hong Kong, and they're going to go triple the price. What I'm saying is this is another hockey puck direction. The paper lie, the scam, the jig is up since 2024 and 2025 when the COMEX failed at delivery and failed at inventory, and the ratios for open interest to available was so embarrassing. And then the price fix was so embarrassing. China, its chief of the Shanghai Exchange said in 2014, this is over 10 years ago, he warned to the Western bankers, very soon China will set the gold price. It will be based on fair price, not paper claims. So what we're seeing is China playing chess as we're playing checkers. You can't have a 200-day moving average in physical gold in Shanghai and Hong Kong and something totally different in New York and London, especially when one is priced on supply and demand from physical and the other is levered paper, toilet paper. And so this is an extremely boring technical change. It doesn't take a huge rabbit hole dive. All I'm saying is if I own something and I give a claim to 10 people for the same thing, well, only one of those 10 gets it. And that's been the paper trade in silver and gold since the 70s. What Shanghai and Hong Kong and China in the East are doing is anchoring the trade in something more valuable, actual supply and demand, less nonsense, less dishonesty. And that gives them more credibility. But again, we love them or hate them, it's a brilliant move. And I've said for years, for China to gain credibility, they have to be smarter than the LBMA and the COMEX and the CME. That's not that very hard to do. We've shot ourselves in the foot so many times with the fraud, the open legalized fraud. And so again, to answer yours, that's an important event in 2026. In a year of already crazy, unforeseeable events. When we met in January, did we see for sure a war in Iran or a conflict? Did we see Silver Friday? No. Are they surprising? Not at all. There's no doubt that America was very worried about the petrodollar or non-dollar oil sales. There was no doubt that the COMEX was going to let silver just rip without a fight. So they're not surprises, but they're hard to predict. And there'll be other surprises that are not going to be surprising, but are hard to pick the date, that's for sure.
Really interesting. And those changes in China, do you think they ultimately push the West to change the way they're doing things? Or is it more about establishing that comparison of like, look how they're doing it here versus here?
I think Judy Shelton would be a good person to ask, right? Because look, when they create this new settlement and clearing order, they're not creating a gold-backed yuan. Just like I said years ago, there'd never be a gold-backed brick currency. What they're doing is they're anchoring the yuan in a clearing settlement system that gives the yuan far more clout and credibility in that system. And what we're doing in the U.S. as we're screwing around with stable coins and centralization and that's a whole other story too. The skunk in that woodpile is promising e-dollars while we're giving you a programmable, trackable, takeable e-token while the issuers make money. What's happening is China is seeing the direction of gold. And because again, the BRICS, China, they don't all trust each other, but they do trust gold to net settle trade. Absolutely. Very farsighted, very brilliant. The world's catching on the U.S. Treasury is important. Stable can't sponge it all up. The U.S., meanwhile, still lives on issuing tons of debt. And so who's going to absorb that debt if it's not stable coin? Who's going to buy our U.S. Treasuries? Well, Judy Shelton has an idea. Let's make it gold-backed. And that hasn't become official yet as of this date. It could be never, it could be tomorrow. But the point is the very fact that a former Fed nominee is openly admitting and getting some credibility and some headlines that for our IOU to be trusted, we have to enter the word gold into the equation. And the only reason that's happening is because at $40 trillion in debt and $3 billion a day in interest rate payments and at a 7% current account deficit, love or hate America, and I love the country, I'm an American, love or hate it, we are technically, empirically, and objectively getting broker each day. And we live off the winds of debt and the IOUs of our Treasury Department, and no one's buying them at the same pace. That's just a sad reality because we've drunk-driven our debt levels, mismanaged our debt levels. So the short answer, Judy Shelton has a gold-backed U.S. Treasury as a possible option. I think that's an interesting reaction to what's happening in China.
Yeah, it would be great to get her perspective for sure.
Yeah.
You mentioned we should talk about what's happening with the Fed. So we've got a new Fed chair since we last spoke, and we've got now a lot of concerns about inflation. And Warsh seems to have some different ideas about how he wants to run things compared to Powell. And I think there's a lot of confusion about people thought he was coming in and he would be listening to Trump. Now, after this first meeting, is he going to be hawkish? What are your thoughts? How are you looking at this and the Fed's path forward under Warsh?
Yeah, I think, well, both Powell and Warsh were nominated by Trump. It's interesting. They were both, in some ways, disappointing to Trump in some ways. I mean, Trump was calling him an idiot not over a year ago for Powell, and there were expectations about Warsh and the regime change, that he would be dovish, though, that he would be pro-Trump because the Federal Reserve actually is neither federal nor reserve. They have independence, supposedly. And Trump can nominate him, but he can't control him once he's in office. So there's dot plots that really don't know what Warsh is going to do. I think he's definitely not going to forward guide the market like Powell did and announce months in advance what he's going to do. There's certainly the market absolutely predicts there's priced in some type of rate hike, actually, by the end of the year, probably in October. That's all the official news, and a rate hike means higher rates to fight inflation. And certainly, Warsh's official stance is we are going to create price stability. He was just in Portugal in front of the European central bankers. We're going to create price stability. We've got to keep inflation near 2% as our target. and there's going to be regime change, and I'm going to have all these different task force. You know, I think they're pretty Orwellian task force, including the task force on information. But I think that's, with 900 PhDs on staff, I'm wondering what have these task force been doing for the last 20 years. So there's a lot of, I say, fugazi from Warsh, and there's a lot of buzz. But here's my simple opinion. Warsh is just like any other central banker. They have the amazing capacity to let words repeated enough, long enough to make them seem true, when their only real options are very obvious. He can talk hawkish all day long. He can wear a dovish costume with a hawkish beak taped to his face, but Warsh is already going to be dovish because at 40 trillion plus in debt, we cannot afford rising rates to fight inflation. And if we did even do that, we hit the fiscal dominance wall, which we saw in 2022 and 23 under higher for longer with Powell. He tried to raise rates deliberately, and what did that result? Gold went down for 5 months, but the interest expense on Uncle Sam's debt became unpayable, and we had to do indirect or direct QE to pay our own interest. We can't afford higher. We literally can't afford it. So we have to synthesize more fake money to pay rising rates. So there is no way to be Volcker 2.0 and raise rates. Powell knows it, Warsh knows it, and I'll explain what they're doing behind the scenes to get that liquidity. But it's an open lie that we can afford to be Volcker 2.0 at 40 trillion. When Volcker, you understand, in the Reagan era, our entire debt was 1 trillion. In the current era, our interest expense is 1 trillion. So it's a totally different world to use rates to fight inflation. So no, Warsh is a maven to the system. He will appear hawkish. He will use terms like regime change. He'll say we're going to target 2% inflation when his own Federal Reserve is already predicting 3.6. That's their target, and the official CPI is 4.2. So it's just an amazing ability to say the sky is green and the grass is blue over and over and over, and the market says, well, that's the official CPI. But Warsh is going to save us. No, he's not. He's going to create liquidity. It's important that every listener understands, whether it's Canada, whether it's in the UK, whether it's in the US, central banks' shareholders are other banks. Their mandate is not employment and inflation. That is their stage show. Their mandate is liquidity for the banks so they can keep lending. Their mandate is keeping the yield on the 10-year of whatever bond from whatever country from spiking, because that makes the cost of debt. So Warsh can do whatever he wants with his various words. But the simple fact is, his only mandate is to keep liquidity into the banks, to keep yields under control, and keep bankers making bad loans forever until the next bust. Because behind every crisis is a banker with his head down, every time. I'm sorry, it's just how my cynical experience, what I wrote in Rigged to Fail in 2019 before another banking crisis. But what Warsh is doing, just like Yellen, just like Powell, just like Bernanke, just like Greenspan, the patient zero of easy money for Wall Street, who sold his gold soul for the Federal Reserve. But what Warsh is going to do is very simple. We've seen in the past, when they need liquidity, when QE is embarrassing, when you literally mouse click a zero every month, or 50 or 100 billion, as we saw in 22 or 21 during COVID, that becomes optically very embarrassing. The world everyone knows you can't just print money and solve a problem. So that's embarrassing. So the Fed and the central bank and the Treasury Department are very clever little liars. So, we'll do other things. We'll bail out the reverse repo markets. We'll put in hundreds of billions in supplementary cash. We'll do things with banking regulations, like really boring things like supplementary leverage ratios, so banks can effectively do QE for the Fed. We'll issue more from the short end of the yield curve, and that'll take some pressure off the 10-year. That's liquidity. We'll take money from the Treasury General Account, boring stuff. We had a major banking crisis in 2023. What did we do over one weekend? We flip-flopped. We gave FDIC complete coverage, and then we guaranteed all the too big to fail banks their bonds, which were 70% of the dollar, we guaranteed them at par. So that's trillions of dollars of indirect liquidity. What Warsh is doing right now, again, another date no one notices, is Basel III, very boring. Basel III said these banks have to have about 90 billion in capital reserves so they can't get in their own way and step on their own feet and avoid crazy loans. That was in March of 2023. I wrote about this. That was to make banks smart and safe. Well, of course, banks don't like being smart and safe. Every dollar that sits in a capital reserve, they can't lever for more risk and more profit for themselves, because they're just hedge funds using depositor money. That's fractional reserve banking. What no one knows, because it's so boring, is Warsh is helping fast track these big banks in New York to avoid Basel III, to just not comply, to take that 90 billion, it's 88.7 billion, but take that 90 billion airbag and make it go away so that banks can just use it to lend more money. When banks do leverage at 10 to 12x, that 90 billion really becomes a trillion in backdoor liquidity for more bank lending. This is so boring and so technical, and I know, but I know your audience can figure it out. It's really actually very simple. It's just QE without QE. It's just the Fed's #1 mandate is the banks, so they can make more loans and more bonuses for that second home in Polo Country, Virginia, or Nantucket. I've seen them. I know who these guys are. I know what they're doing. So I'm sorry, it's just the same Fugazi. It's smoke and mirrors. It's talking tough in Portugal. It's talking about target inflation when, come on, even the 2% target we reached for 30 seconds in 2020, it raced to 9%. Before that, it was below for years during deflationary periods. Who are they kidding? Who actually fact checks the nonsense they say but becomes so habitual that people just buy into it? No, we're not at target 2%. The 3.6 that the Fed forecasts is actually lower than the 4.2 we have now, but as everyone knows, the CPI scale by the Bureau of Labor Statistics is open fiction, but it's what the market trades on. I, like many others, Mike Green, I think is brilliant. I think Luke Roman agrees with this. The compounding annual growth rate of inflation is really closer to the compounding annual growth rate of U.S. debt. We are much closer to 10 to 12% or 8% to be generous inflation than we are at even the 4.2. And again, I'll end with this. If we're looking generously at just 10% inflation, real, not CPI, the disastrous comedy that is. If you're at 10% inflation, that means you're losing 10% of your wealth every year invisibly. But more important, that means a 10-year bond that's giving you 5%, 4.6% yield. You're actually losing 5% on the risk-free return of a 10-year treasury. It's actually return-free risk. And that's what the world doesn't know, and that's what Wall Street and DC and the Treasury Department and the Fed doesn't want you to know, because they want you to buy U.S. Treasuries. The trouble is no one is. The only other way to get you to buy them is to force you into an e-dollar or a stable coin that forces the issuers to buy treasuries. That's how desperate and broke our U.S. Treasury is. At least in Japan, the Japanese buy their own JGBs. No one wants our U.S. Treasuries. So the only way to get it is to have Tether, Circle Internet, and now BlackRock and DoorDash issue a stable coin to force this embarrassingly unloved IOU to be bought. It's really fascinating, and it's desperate.
Yeah, you paint a very vivid picture of what's going on there, and I think we can tell all the drivers behind gold, even though the price is down right now, and we probably don't need to worry about that because of what's coming. Before I let you go, I do want to bring up silver, at least briefly, so we can understand the case for gold. We can see all of these underlying drivers. How are you looking at silver right now? What does the picture forward look like for you?
Well, when you look at silver, I mean, look what happened again right after we met, and you had Silver Friday, and you had another margin hike, and you saw the largest fall overnight in silver in 40 years. It was 35%, it was like 44 years, and nothing fundamentally had changed at all, other than raising the margin requirements. We saw in 1980 and in 2011, the CME and the COMEX do the same thing. In 1980, they made the COMEX suddenly sell only. That was to crush the Hunt brothers who were trying to corner the silver market. 2011, they did 5 margin hikes in 2 weeks. So the first thing is, let's call a duck. That wasn't natural price discovery. That wasn't retail demand. That was a deliberate manipulation by the New York Exchange to save the banks from themselves because they were in a short squeeze. Not only did it save the banks from a short squeeze, it allowed the banks to accumulate the silver. Why? Because they see the direction of the price. It's a critical mineral. It has a 1 billion ounce supply and demand deficit mismatch. So obviously silver's gonna go up in price. So what do the insiders do? Exactly what I would do if I had no conscience, worked at the CME and sold my soul for a good post in DC or at JP Morgan. I'd fix the price down, I'd accumulate it before it goes much, much higher. So if you understand the world as cynically as I do, this is a sale price right now. They gave it to you, they gave it to themselves. So for me, the supply and demand fundamentals are absolutely the same, if not better. The price fixing that squeezed or that hurt us actually and bailed out the banks is the same one we can take advantage of. Again, don't like the banks, but do what they're doing. They're accumulating. Now, because of the rules and regulations that nefarious thing called the New York COMEX, which is run by the CME, which used to be a legit business, now it isn't. They don't have to disclose who's buying, who's selling, and how much is stacking. I'm quite sure that the massive sell-off we saw in January and later in February was picked up by JP Morgan. I can't quote that. I know some people who know some people. I think JP Morgan is stacking silver. They create their own sale prices and they accumulate. They only do that because they do see the longer-term direction. What's sad is the tourists or the people that were coming into silver at the end on the headlines and hoping it would go in a straight line, which, as you and I discussed, it never does. If you're in this for the trade for conviction, you can handle this volatility. If you're in it for a momentum, it's heartbreaking and brutal. And if you have the conviction this will make it safer for you, I think it's also important to understand the volatility in precious metals in a bull market. Remember, in the last major headline bull market in gold that everyone does know, and silver was certainly the beta trade there, was the 70s. But during the trip from 35 to 850 in 1 decade, gold saw 5 20% or greater corrections during the bull run. And it cut itself in half halfway through between 74 and 76. Went from 200 to 100 before going up 8x. All I'm saying is, no, the bull runs don't go in a straight line. There is a reason for the direction. The bull run we're in now is only just beginning. There are going to be shakeouts. There are going to be price corrections for different reasons that are foreseeable and unforeseeable. But 2026 is much different than 1970. And actually the bull run we're about to go into, which is why I'm completely indifferent to the daily price for my need for gold, because I'm a preservation guy and I'm long-term. And I'm not insulting those that are trading, but for me and my clients, I'm completely agnostic. I see the debt levels today versus 1971. I see the currency debasement today versus 1971. I see the state of the US Treasury today versus 1971. I see the state of the petrodollar today versus 1971. Everything is worse today than 1971, and gold is just starting. And people may think 5,000 was a peak or 5,500. No, it just isn't mathematically. And there's only so many tricks the West can do with the COMEX and the London exchanges to play this game out, or to save the petrodollar by invading every country that wants to sell outside of the petrodollar? You can take Maduro, you can take the Khomeini, but can you? At some point, China's going to have an opinion. All I'm saying is, I'm not anti-American. We have gone too far. Our debt's gone too far. All these indicators have gone too far. We can't kill everyone that wants a non-dollar energy solution, and we can't make a dead, dying, debased dollar any better than it already is, and we can't force U.S. Treasury purchase beyond stablecoins any further. And more importantly, love them or hate them, the BRICS in general, and China in particular, aren't about to give up. And while we've spent the last 15 years winning hearts and minds in one war after the next, China's been building ports and infrastructure and roads. And so I'm not pro-China. I'm never going to live in China. I'd much prefer the U.S. Love it or, I'll never leave it in the sense that that's my country. And I will always be an American, but we have to be patriotic Americans. We have to be critical, not of left versus right, but of right versus wrong. And right, sound money is essential, and we cannot live beyond our means. Thomas Jefferson knew this. Alexander Hamilton didn't even know that. Even though they debate about the Fed, we can't live like this. So there is going to be costs, and the costs are going to be in the currency, and that is why I hold gold. And that is why so many of my clients, even though I'm in Zurich, are Americans holding gold. They're not anti-American. They understand basic history and basic math. And America's put themselves in this, not Americans, but America as a country has been so grotesquely mismanaged, as Hemingway warned, that our only options are currency debasement and war. And for me, gold is the antidote to that nonsense. And it's sad, and I think America will get through this and will come out better. But in the meantime, gold's going to have a lot to say.
Well, I think that's the perfect place to wrap it up. I think,
Yeah.
Thank you so much for coming on to talk about what's happening with gold, the market, silver, always very enlightening.
My pleasure. It was real fun. Thank you.
Yeah, lots of fun. And for now, I'm Charlotte McLeod with investingnews.com, and this is Matthew Piepenburg with Greyerz.